All right, good afternoon, everybody. Welcome to the class for today. Glad you are here. And we will jump in here real quick and talk about managed by the Greeks. And our hearts go out to anybody in Florida with the hurricane and all that stuff. Our thoughts and prayers are with you. And yeah, pretty bad. All right. Well, we're launching our Managed by the Greeks class, which will be starting 2 weeks from today. We haven't done, I think the last time, sometime over a year ago, I did just an abbreviated 1 day for a few hours, kind of introductory Managed by the Greeks, but this will be starting in 2 weeks from today. It'll go 4 weeks, twice a weekend. I think we'll be doing it Tuesdays and Thursdays this week, unless still might be a change, but I think that's what we'll do. And I think that this is, to me, you know, out of all the classes that I teach, I think it's the most important, only because being successful as an income trader comes down to how you manage the trades. And, you know, all iron condors aren't the same, all butterflies aren't the same, all credit spreads, they all start out different. They have different Greeks at the beginning. And so it's really comes down to how you manage the Greeks, your, you know, your price, risk, delta, and gamma, your time decay risk, which is theta, and then your volatility risk, which is vega. And in this educational world of options, a lot of people want to get things handed to them like you had your lunch bag from your mom would make for you when you were going to elementary school. You know, you got your piece of fruit, your piece of candy, your sandwich, and your drink or whatever, and it's not that clean and easy. And so I think learning to manage trades by the Greeks and understanding that is a crucial skill. We're going to talk a little bit about that today, but we will be teaching during the class how to manage the Greeks regarding calendars, credit spreads, iron condors, multiple trade positions, butterflies, all the way down cash secured puts, covered right type strategies. So you know, it really helps you to dial in on how really to manage a trade, you know, and instead of just being a rules-based or seat of your pants type trader. So we'll jump in today, talk about a few things, and go from there. This is for educational purposes only today. So let's dig in and talk about a few of the things. Some will be maybe a little more basic for you. Some might not be. We'll see. So managed by the Greeks, you have price risk. And managed by the Greeks simply means managing a trade by looking at the 3 or 4 different types of risks. Your first one is going to be price risk. And when you're talking about price risk, you're talking about 2 Greeks, right? Talking about price risk, you're talking about delta and gamma, right? And delta, you can always look at delta in terms of stock equivalent. So if your position is short, you know, if your position is short, you know, 20 deltas, right? And here's a symbol for delta. Well, you know, what does that mean? It means if it goes down $1, you make $20. If it goes up $1, you lose $20. So think of deltas as stock equivalent, right? Let me give maybe an easier example. If you're 50, you know, if your position deltas are 50, think in terms of stock equivalent, especially for a smaller move. So if I'm 50 deltas long, we go up $1, I make 50 bucks. If I'm 50 deltas long, just like if I was 50 shares of stock long, if it goes down $1, I lose $1, or I lose $50. So delta, look in terms of stock equivalent. Gamma is just telling you how the delta is going to change if we go up $1, right? Correct? Or down $1. I mean, that's really what it's going to teach you. So if you look at had to sneeze here. I don't want you to catch the sneeze. If we have an example, if the stock is at XYZ is at $100, and you have the at the money let's say October 100 call, should have a delta of around 50. A gamma is telling you how much, and let's say the price is $3. Gamma is telling you how much, what that delta will change to if we go up $1, right? In other words, it's not the same. If XYZ goes from 100 to 101, goes up $1, right? And it's got a delta of 50, what's that call going to go to? What's that call going to go to? It's $3. You pay $3 for an at-the-money OC 100 call. What's that call going to go to if XYZ goes from 100 to 101? It's got a delta of 50. What's it going to go to? It's going to go to 350, right? So gamma is describing how your deltas are going to change, right? Stock has no gamma. If you own 100 shares of stock at 100, you own 100 shares of stock at 101. And you know what? You own 100 shares of stock at 99. So gamma is just describing this delta phenomena, how that changes. And significance of plus or negative gamma is that if you if you buy a call, or significance of plus or minus gamma would just be most of the trades that I teach, income producing trades like range bound stuff like butterflies and credit spreads and calendars and iron condors, they're going to have negative gamma. And what that means is if my deltas start out at 0, if we go up $1, I might get short deltas. And if we go down $1, I get long deltas. Is that good or bad to get short deltas or short stock as we're going up and long deltas or long stock as we're going down? Is that good or bad? Is that good or bad? That's bad. But you can't have your cake and eat it too. So income trades like butterflies, calendars, delta neutral type trades, we're going to get shorter deltas on the way up, longer deltas on the way down. But what's the other side of that coin? To have Greeks that go against us, what's the other side of that coin? Do we have positive or negative theta? Positive or negative theta? Positive theta. Yeah. Now, somebody asked, gamma changes the delta with price move, but also with time? Yeah, let me ask you, does gamma change over time? Does gamma change over time as we get near expiration? Yes or no? Yes or no? Does gamma change as we get closer to expiration? Dramatically. And that's why many times when we're managing iron condors or butterflies or income trades, I yell at the top of the roof of my house, get out! When you're about a week from expiration at the latest, get out! Why? Because the rate at which your deltas will change changing against you on these negative gamma trades as you get closer to expiration is exponential. And so, you can, from a practical point of view, what that means is you could be up $1,000 and then down $1,000 the next second because things change a lot of the last week. So these are the most important, in terms of the Greeks, these are your most important Greeks, in my estimation. Price risk, your most important of the Greeks, number one, is your delta and gamma, right? Delta's, I would say, by far, but delta and gamma, but price risk, that's the number one thing to focus on. Which one do you think we're going to rate these the most important, 1 to 4? What do you think? This is just margin or risk capital, but what do you think out of these 4 is the least important? Yes, Wayne, gamma is the rate of change of delta. Which is the least important of these 4? Rho. Yeah, this means nothing, especially with the way interest rates are. This is, unless interest rates go up dramatically, this isn't even, forget about it, So number 1 is price risk. I would say number 2 is going to be volatility risk, which is Vega, how the volatility changes. And then number 3 is time risk, or theta. But for income trades, a lot that we do, time risk is good. I mean, we like time to pass, right? So really the 2 main risks that I deal with all the time for, that I think you should focus on is your price risk, which is delta and gamma, and then volatility risk, which is Vega. If we take the Greeks of a long call, 25 days from expiration, so here's a graph of a call 25 days from expiration. You can see the green area, right? The green area is that's the expiration graph, how things will look in 28 days, right? This graph here is the graph of the trade today, right? And so with a long call, if we don't move, right, for a long call, if we don't move over time, you can see here's the under 0, the loss, that will increase, typical long call. So you can see here's an example in SPX of buying one of the OC28. This is just, I'm just taking this graph from, Thinkorswim. I just took it right off their brokerage. A question said, Charlotte said, and yet the Fed interest rate game seems to send the market into tailspin, so does the row is theoretically the least important, but in today's market it throws sentiment and RSI becomes the dominant factor. Kindly give your opinion. It's just that what I'm looking at, Charlotte, is that in terms of the effect on an options price, what the Fed does with interest rates change whether the market goes up or down, but in terms of an option trader, do interest rates change the value of my option? Right now, it's not a consideration, right? So here's the, if I buy one October 2160 at the time where I took this slide, so that's an at the money. The price is around $26. The volatility of that option is 10.97, let's call it 11 in SPX, and the delta of an at the money would be 51. Let me ask you a question. Is an implied volatility of an 11 IV of an at the money call in SPX, is that high or low? Is an implied volatility of 11 high or low? low, right? Correcto. And as we see, it's got a delta of 51, a theta of 49. All right, does that number get, does the negative, so it has a theta of negative 50. It's a theoretical number. Basically, it's 50. That means today, or the day we put this on, I have theta of $50, and that number increases as we go towards expiration, especially towards the end, right? That's just saying rate of decay, how it decays. That number will grow, and it's a long Vega trade where, because you're buying a lot of time premium, if volatility goes down, you can lose quite a bit, right? And so, you know, that's the Greeks of a long call. And so, yes, you have price risk when you buy a call, but if you buy volatility, if you buy a call when the volatilities are high, then you have a lot of volatility risk. Is there a lot of volatility risk for long call buyers right now in the market? Is there a lot of volatility risk for long call buyers in the market right now? Is there a lot of volatility risk? No, right? I mean, volatility risk, not a lot. Now, 14 days into the future, you remember the theta was 50, 14 days into the future for a 28-day or 25-day trade, 14 days in the future, our theta went from 51 to minus 71, right? And our Vega, right? Our Vega went from 229 to 151. So why on a 25-day trade would our Vega go down 14 days into the future? Why would the Vega of a at-the-money call 28 days till duration, if you put it for a 28-day call, why would the volatility go down almost in half as you go 14 days in the future? Anybody know? Why? So we have a call, 25. You buy a 25-day call at the money in SPX. You go 14 days into the future, so there's 11 days left. Why would the Vega go from 229 to 151? Yeah, the answer is declining time premium, right? There's less time premium. And that's what volatility is a measurement of. Volatility measures time premium. You could see 21 days in the future on a 25-day position, and you could see the graph of the position. Today's graph, you can see it's all underwater, right? And that's your biggest risk on an at-the-money call, right? And that's your biggest risk of an at-the-money call because your theta goes up. So we're 21 days in the future. Your initial theta was 49 minus per day. Then it goes to 71 minus per day, 14 days in the future, 21 days in the future of a 25-day position. That negative theta adds up, and so you can really get hurt. So it's important to understand that. And, you know, in a low-vol environment, if the stocks, I'll just give you an example, if XYZ is at 100, even if volatilities are cheap, right? So I buy one 100 call with XYZ at 100. If volatilities are low, one thing I could do to offset the potential risk of a call, because you spend a lot of money for an at-the-money call, you know, you could just sell a 110 call, right? That's called a call debit spread. And when volatilities are low, which they are in the market, if I'm going to do a bull call spread, a debit, where maybe I'm bullish, XYZ's at, let's say 100, I buy one 100 call, sell one 110. If the volatilities are low, I want to buy something with more time premium, sell something with less time premium. So buy a 100 and sell a 110. If volatilities were higher in the market, right, I want to sell the strike that has the most time premium, right, if I'm bullish. So if the volatilities are higher, I might buy one at the 80 strike, sell one at the 100 strike. If that's where the underlying is at 100, if the volatilities are higher, I want to sell the one that has the most time premium. If volatilities are lower, which they are in the market right now, I want to buy the one with the most time premium and sell something with less time premium. So even, if you're buying a bull call spread, if you're bullish, depending on if the volatilities are high or low, will determine which strike I buy and sell. The Greeks of a bull call spread, here's an example with SPX at 2158. And I'm buying one. I'm going to have a couple quiz questions in a second, and we'll see how you guys do. But I'm buying, in this example, a 25-day. This is in October. I'm buying one 2160, basically at the money, and selling one 2170 call, 25 days out. And I pay about $5.80. If I pay $5.80 for this bull call spread, what's my risk? If I pay $5.80 for this bull call spread, what's my risk? $4.20. The width of the spread is 10. What did I say? How did I word it? Did I say what was the risk? Did I say what was the risk? Your risk is what you pay for, right? What I could make is the difference between the strikes, 10, minus 580, which is 420. And I make 420 if the price is above my short. But my risk on a call bull spread is what I pay for it, right? And so I'm buying the 2160s, selling the 2170s. Now, I got a question. All right? So everybody can see that the cost of this is $5.80. Give me an approximation. You have enough information that you could see it there, right? Here's the question. I pay $5.80 for this. Give me a rough idea. If the stock goes up $1, theoretically, what will this price go to? If the price of SPX goes up $1, approximately, theoretically, what will that go up to? What will that go up to? The answer would be the price right now plus the what? Plus the delta of 66, right? That gets you about 646, right? Again, the delta of this trade, if you buy on this particular trade, I'm sorry, this would be 10 contracts. If I did this bull call spread 10 times and the position deltas are 66, if we go up $1, and I'm paying 580, this trade would go from 580 to 580 plus 66, right? Yeah, plus the gamma. Yeah, I'm throwing the gamma out of that. You're right, Dino. It'd really be less than that, right? Thank you, Dino. Now you can see the Greeks of a bull call spread. We're doing this 25 days from expiration, and you can see your deltas are 66 long. It's a little bit short gamma. Negative theta. Why is it negative theta? Because we're buying the ones with the most time premium, the 2160s, and selling the ones with a little less time premium. We're long vega because we're buying the one with more time premium than the one we're selling. Now, so this is a picture of it and information 25 days from expiration. And if you look at here, as you go 25 days in the future, your theta goes up. Why? Because you're getting, again, you're buying the calls at the money. Your theta goes up because as you get closer to expiration, your rate of decay goes up a lot. Understand that? And so you could see the, anyways, stuff to look at. Now, get ready for your quiz question. So we're going to look at delta and vega of 25-day options. And again, the key things to look at is your vega. If you're looking at the money, let's say at 2160, as you go out of the money, more out of the money on the call side, your volatility shrinks because there's going to be less time premium involved. Your delta is going to get smaller as you get more out of the money, right? There's less time premium. Deltas get smaller. Most of you know that. Delta and implied volatility of 25-day options in the indexes, you notice that as it calls, if this is your at the money, as your calls get more out of the money, your implied volatility drops dramatically in the calls. Now, if we had the puts here, it goes up, right? As you get more out of the money. And this is more, this happens in some equities, but it's more in the indexes. Now, I got a question for you. Here's my question. You ready? Get ready for this question. So, everybody with me? We're at 2160. We're looking at these OCT 28 expiration about 25 days out. We're at 2160. Which spread has more volatility risk, right? You with me? We're at 2160. Which spread has more volatility risk? A, I sell one 2160, buy one 2170, excuse me, so an at the money call bull spread. So here's the question again. We're at 2160. A, if I sell one 2160 and buy one 2170 in the calls, that's called a call credit spread. Everybody understand what that is? Yes? No? Right? It's a call credit spread at the money. I'm selling an at the money 2160, buying one 2170. B, B, I'm selling one out of the money, 2190, buying one $2,200 call. So this is an at-the-money called credit spread. This is a out-of-the-money call credit spread. Which one has more volatility risk? Which spread? A or B? A or B? Feel like you're the eye doctor? A or B? Next, C or D? Which has more volatility risk? This is 28-day, 25-day call credit spreads, 25-day expiration. A, selling 121.60, buying 121.70. B, selling 121.90, buying 122.00. Which has more volatility risk? Drum roll. Let's see what you guys said. Many of you said A. Most of you said A. So what do you think the answer is? Most of you said A. So what do you think the answer is? It's, of course, it's B, right? It's B. Right, so let's take a look at this. Greeks of a call credit spread. Here's a call credit spread at the money, right? Where you're selling the 2160s at the money, and you're buying the 2170s. If you look at the Greeks, we're 65 delta short on the position. We're short a little gamma. We're positive theta because the options we're selling are going to decay quicker than the ones we're buying. There's more time premium. And your vega is short 27. Everybody with me? So vega short 27 theoretically means if the IV goes up a point, we lose 27. If the IV goes down a point, we make 27. Everybody get that? Why? Well, again, we're selling more time premium in the at the money than we're buying in the out of the money. So if volatility goes up, we lose money because we lose more in our short because we sold more time premium than we bought. And if the volatility goes down, right, and we're short vega, we make money. Why? Because we sold more. The ones we sold are at the money. We sold more time premium than we bought. So if time premium shrinks, if volatility goes down, we make more in our short than we lose on our long. Now, so vega of short 27. Here's a Greeks of a call spread, 25 days to expiration, and we're selling the 2190s, and we're buying the 2200s. We're short 71 deltas, short gamma, positive theta. Any of you surprised with the vega? Is the vega a lot bigger on the out of the money stuff? Yes or no? Do you know your Greeks today? Do you know your Greeks today? Do you know your Greeks today? Early in the morning. All right, why do you think that is? The Greeks were short 27 on an at the money call spread, and our Greeks were dramatically bigger. Why do you think, my friend? Well, think about it. If you're 25 days from expiration, right, and you're in a $2,000 vehicle like SPX, is there that much difference, vega risk between and at the money and 10 points out of the money on a $2,000 vehicle? It's too close. There's not that much difference. But now when you start getting out of the money more, right, we're selling the 2190s, you know, you're talking 30, 40 points out of the money, you're going to get more of a difference. And that's really what it is. I mean, especially when you get a higher price vehicle, you know, and they have the price $21.57. So the difference between $21.60 and $21.70, you know, there's not that much with this much time left. Yeah. Something to think about. Now, here's a 71 versus 43-day calendar. I did this looked at this October 5th, right? And here's one of the problems, you know, people that are doing longer-term calendars. So I call this a 43-day calendar. So we're buying our long option 71 days out. We're selling our short option 43 days out. So I'll call this a 43-day calendar. I determine, you know, so I say a 43-day calendar is based on how many days to expiration the shorts have. It's a 43-day calendar. So to me, there's two groups of calendars. I might do calendars, maybe a 4 to 11-day calendar. That's short term, right? That means your short option expires in 4 to 11 days. And then you have longer term calendars where your short expires 30 to 50 days. So these are longer term calendars. And they have totally different Greeks. I treat a 4 to an 11-day calendar much different. It's a different trade to me than a 43-day calendar. So this is a longer term calendar. So here, SPX is like 2161. So we're selling, in this example, we sell the at the money, which is the 2160. We're buying 10 of the December 2160 calls, and we're selling 10 of the November 2160 calls. Now the cost of this is $10.85 per calendar. This is an SPX. And you can see the graph, right? So you have here, that's the expiration graph, and that's your graph. We call that a T+0 graph, or your graph today. So the Greeks of this, if you're doing it at the money, your deltas are pretty close to 0. There are 2 here. Your gamma short -1. Your theta is positive $82 a day. But your vega is 833. So when you get longer term calendars over 30 days, volatility is a big component. It's a big issue. When I'm looking at calendars 4 to 11 days from expiration, I don't look at this as much. It's not as big a deal. But you can see, you know, one of the main reasons people struggle with call calendars, especially over the last 3-4 years where the market's been in an uptrend, is you have this, you know, if we're going from maybe if the volatility starts shrinking and a market goes up, even if you're delta neutral, you lose money because if the volatility comes down, right, you're long a lot of volatility because your longs here, your December options, have a lot more time premium than your November. So one of the things I will talk about in the class, I talked about in the recent calendar class, is if I'm doing a longer term calendar over 30 days from expiration, because of the tremendously long vega, I want to start the deltas a little bit long against my long vega. So when I'm doing a 43-day calendar like this, in most situations, if we're at 2160, I'm going to start the calendar a little bit higher at the 2170 strike or the 2175, not because I'm bullish, but to offset the long vega or the volatility risk which you have if the market goes up. So anyways, how many of you need a good Excedrin headache or Excedrin aspirin after a little bit of a discussion on the Greeks? How many does your head hurt as you start describing the Greeks? The only way to really understand the Greeks is really to do it. And I want to invite you 2 weeks from today to jump in, join this. I think it'll be a very practical, helpful class to you. Managed by the Greeks, we're going to put on a bunch of live trades, follow them from beginning to end, show you how to do this, show you how I analyze trades with, this is how we manage trades in the pits, managed by the Greeks, and I think this is the most effective way to manage trades. You know, you can't include when people manage, try to make us, you know, again, especially if you're an engineer, you want a system, don't you? If you're an engineer, just give me a system, right? But you know what? The best system in the world it doesn't come close to the Greeks because it doesn't take it, you know, it's trying to give you a cookie cutter way of doing it. If you really want to trade, this is how you do it. And so, you know, whether it's a calendar or butterfly or multiple positions, we'll go over that in the class. It'll be over 8 weeks. Each class is about an hour to an hour and a half. And again, we go live trades all the time, which we do at all our classes. And I think it'll be a big help to you. No, I'll be trading a lot of different. We'll trade SPX, RUT. I'll be trading some stocks. I mean, you could trade SPY. I just think SPX and RUT are better vehicles. But SPY is pretty good. Some people trade SPY. But I'll trade some different vehicles during the class also. And then, so as I said, it's about 10 to 12 hours of live content. Class is taught every Tuesday and Thursday at 1 p.m. Central for 4 weeks. Every session is recorded, annotated, and archived for you. One of the great features of the class, during the class, and even if you watch it archived, there's a button that says Ask Dan a Question all the time, and you can just, anytime you're reviewing, you can ask a question, they come to me. And I probably answer 10, 20 questions a day. You can download and print all class materials, and the cost is only $397 for about 12 hours. And again, I put on live trades every class to show you exactly how to do it, so very practical. So anyways, folks, well, thanks for jumping in. Here's a little bit more information. You can see a little bit of a rough outline, what's going to be covered, who's teaching, what are the days. The class will run through the middle of November. I promise you'll be done by Thanksgiving. The first class is October 20th. And again, you can get all that information but yeah, in you know, Thinkorswim or some of the others, you can do everything that I'm talking about in an IRA, right? So I know for Thinkorswim, you can do everything that I'm talking about in the class in an IRA, right? The way I'm teaching it. So will the class be recorded if we can't attend every session live? Everything will be recorded. So the classes are at 1 Central by 3 o'clock, 2:30 when the class is done. They'll be archived. By the time you get home from work, it'll be up there. And as you're watching the material, many of your questions will be answered. But if you still have questions, you just hit the Ask Dan a Question button. And not that I'll answer it. You know, I may be in bed, but if I'm not in bed, and you know, usually I have a pretty good turnaround within 12, 24 hours. Your question will be answered usually much quicker, unless you email me in the middle of the night or something. And we'll go from there. So look forward to it. I think, again, I think this is the most important class we teach, just because I think the most important criteria, you know, to be a successful trader is risk management. So hope to see you guys, folks. And 2 weeks from today, you can sign up on our website and have a great day. We'll see you later. Thanks.